Sandeep Bhatia, head of equity with Macquarie Security, joins us now. Sandeep, good morning. Thank you for joining us. Sandeep, whereas we can look at our, we can feel excited about ICICI Bank and State Bank of India or Axis Bank. The problem is that we are underperforming global markets very significantly this year. Globally, there is a risk-on moment. Crude is up 15%, Dow is up 6-7%, emerging markets are up, but Indian markets are languishing. The Nifty is underperforming, and small cap stocks, they continue to get crushed. Why is that happening? When we started the year, the promise of good macros was making us look special. The narrative was that this will be the year of outperformance for India, but 4 weeks into trade, and it is reversing.
So I think January 1st, January is just the first month, so it's a bit too early to judge what will happen through the year. It's not necessary that you have to outperform at every point in time, at all points in time, and every time. I think 2017 we clearly outperformed the emerging market pack with all the problems which happened in China and continue to plague China, which is one of the largest exposure for any emerging market investor. So we had actually a very choppy first half, if you remember, in 2017 in the budget and the imposition of taxes and the high oil prices, and in the second half we outperformed. I think this is the similar story in 2018. We'll have a choppy first half and we'll have a stronger second half. We are running into headwinds both on elections. We are running into very populist noises coming from both the opposition and the ruling parties. We are also running into headwinds on global growth and trade. These headwinds will play out in the first half. So to that extent, there would be choppy and sideways performance for the markets in the near term.
Right. Sandeep, since you just did mention about the budget, tomorrow's event, do you think it's going to be a meaningful market-moving event, or do you think it's going to be run-of-the-mill, populist in tone, farm loan waivers, what have you?
No single event and no single budget in my 25-year history of looking at the markets has been a market-moving event of a lasting nature. We saw that last year, despite the imposition of long-term capital gains tax. It's something which has been digested in the market a year down the road, and it's questionable whether you will have to pay any taxes in the first place. So given the performance of the markets, and especially mid-cap stocks. So I think one event is never going to be as important as you think it is when you are near the event. As you go past the event and as you have some distance between the event and yourself, the perspective is much more balanced. So I don't think this is going to be a market moving event in a year's time, this coming budget. I think the only thing that I will look at is how the populist noises are increasing across the board. I think if there is an increase in populism and increase in fiscal spending and so on and so forth, as we have seen with quotas, it's very difficult to roll back any big promises that you make which are incrementally new and different. And if we go down that route, it basically just puts more pressure on the fiscal side. So that is something which I will watch out for.
Okay. Do you think there could be something out of the box that could surprise investors for the markets per se? Is there something that you're penciling in from that perspective?
I think there could be some leeway on personal income tax. Tax rates or tax slabs may be moved up and tax rates may be moved down. To that extent, it's a small positive, incremental positive for broader consumption. I don't think anything else can happen. If you see the tenure of this government, there are some big seminal changes in terms of legislation which have made an impact, whether it's GST, whether it's NCLT, whether it's RERA. So all these are the bigger things which will have a longer term impact. I don't think a budget is one event which has such a long term impact as making these very important structural changes which have happened in the last 4 years. So to that extent, I think there could be tweak and boost to consumption if income tax slabs come through, or if some kind of populist schemes are announced which help farm income and spending.
Sandeep, so I'm going to construct a scenario, and that to my mind really looks like a logical scenario, that the headline number on fiscal deficit is not compromised, because they compromised that number last year, and I don't think they would like to compromise that 3.3% number this year. But the quality of the assumptions will remain poor, and all the populist schemes would be bundled here and there, and there would be a lot of sound and fury about the quality of assumptions. So what happens in that kind of a scenario where the headline number, which rating agencies are obsessed with, they will get what they want, government will get their way by smokes and mirror, and the quality could be compromised.
I think the market then trades down. I think the market does not need to look at one headline number. I think any investor should look at multiple parameters when investing. The macro parameter is one such parameter, the company-specific management, the company-specific industry structures, the company's own positions are some other parameters. So I don't think there's one parameter ever that is going to be the deciding parameter in any investment decision. And as far as the markets are concerned, they'll look at the quantum of borrowing. They will see whether these are schemes which have any long-term impact in terms of committed spending. Maybe the spending is low in the first year, but the committed spending over a long period of time becomes a big figure which balloons and eats into your fiscal space. So all these issues are definitely something which are noteworthy, and one headline number on GDP growth or one headline number on fiscal deficit is just that, as you mentioned, just one number. And as I said in the very beginning, look at multiple things, look at the texture of what the numbers are coming through, look at whether this creates any committed spending over long periods of time, or which changes the structure of doing business in India. And all these are issues which the market looks at, and if what you are saying is the scenario, then the market of course trades down.
What do you make of this rally in corporate banks? There is reason to get optimistic because they are at the right curve. But my only fear is that corporate banks are getting it's becoming more like a crowded trade. The sense what we got with NBFCs and HFCs a year and a year and a half ago, that everybody was bullish on it and everybody used to own them. I just get a sense that with corporate banks also, from an institutional standpoint and from a brokerage standpoint, that seems to be the positioning.
I agree with you. I think corporate banks are becoming increasingly a consensus crowded trade. It's not at the level which you gave an example of in your question about NBFCs and HFCs. NBFC has been running for a very long period of time and showing stupendous growth for a couple of years, and not just recent phenomena which the corporate banks have started now showing some improvement. It's still very narrow, the improvement. As you mentioned, it's primarily with ICICI and Axis that this improvement has been noticed. It's not very widespread. When we saw HFCs and NBFCs, it was all kinds of kinds of quality and sizes of NBFCs and HFCs which were getting marked up for at least 2 years. And then we had this major reality check about what is the quality of the books, what is the quality of the accounting, what is the quality of the managements, and this reality check has actually not completed. To some extent, this reality check should also figure in the wider banking system. And the impact of that, if these NBFCs, HFCs are seen to be much weaker than what we originally thought. So I agree with you. We are getting into a consensus trade zone. It's still not become as skewed as the NBFC, HFC trade was last year. And that is something which we should watch out for. The real challenge in the market, is the fact that we have not seen the diversity of sectors which at this point in time in the cycle we should see in terms of movement. So we still have broadly the consumption stocks which are doing well, and now the corporate banks which are doing well. The autos have become weak. They were strong for some time, and I think the autos may remain weak for the next couple of months until we see some stabilization coming through in auto sales. Capital goods stories have been weak for the last 5 years, and that's something which has not helped. Most PSU stocks have not gone anywhere. So I think it is the real challenge for this market is the very narrow set of sectors and stocks which have performed, and most of it therefore gets very crowded after some time, as you said.
Sandeep, just want to address the panic in the market start of the week. There were a lot of liquidity concerns that NBFCs will only see tighter liquidity conditions from here, and this all, I guess, sprung out from how much mutual funds have exposure to SL Group's debt. Do you think this panic is justified? Because the fear is that, God forbid, this balloons and escalates into an IL&FS kind of debacle.
I think NBFCs, the quality of management, the quality of the balance sheets, the quality of the funding on the liability side, the quality of assets and the loans that they make out on the balance sheet, the overall quality of regulatory supervision are all inferior to the banking system per se. And therefore these worries have still to be priced in for the entire sector and for also the financial stocks, including the banking sector. I think this is something which will continue to play out for the next 6 months, and probably we will see a tightening financing on the liability side for a lot of these low quality NBFC players going forward, and some of the assets may also be of doubtful quality. So all that means that this space will continue to get squeezed, and it could have also domino and ripple effect in other parts of the banking system. So I would think that that story still needs to be played out. And we have, whole of 2019, so to say, when this will be actually one of the major stories of the year.
Okay. What is it that you are penciling in terms of your expectation from the commodities market? What's happening with the metal sector per se, and how you'll be positioning yourself there?
I think commodities are driven by a strong global economic growth. We have seen the peak of growth last year. The US has peaked. China has definitely peaked. There would be maybe a couple of rounds of stimulus in China through 2019. As we know, every time you give a stimulus, it is to have the same effect, you need a larger stimulus into the system to get the same amount of positive bump in growth. China has gone through various rounds of stimulus at various points in time. In fact, the problems which China is seeing today are the results of the stimulus which came in 2009, 10, 11. During that phase where there's a huge internal credit expansion which the Chinese economy has seen. And we have then seen various rounds of expansion and credit expansion happen in 14, 15, especially 15, 16. And now in 18, 19, we have to see another phase of credit expansion which is needed. I think essentially China is in the same difficult phase that India was in 2014-15, when there was a balance sheet contraction of the banking system which is necessary, and growth needs to take a big hit for these excesses of the previous years to get washed away. The Chinese political system has not allowed these kind of things to happen. So to that extent, I think growth will remain weak going forward for China, which is a major commodity importer and producer too. So I think to that extent, we will see weaker commodity markets going forward.
Why are auto companies suffering? Maruti told us we are suffering because input prices have gone higher. Bajaj Auto told us that we are suffering because raw material cost is hitting us. We got the same kind of a sense, when we spoke to the management of Ashok Leyland. So we are making a case of commodity prices going lower, which they have, yet auto companies are crying.
I think auto companies are facing many other issues. The primary issue that the four-wheeler market has faced is the demand issue. And demand issues have been something which came up in the first half of 2018 when when the petrol prices were going over 90 rupees. Two-wheelers and four-wheelers also faced the impact of higher insurance cost for 3 years and 5 years when you buy a new two-wheeler or four-wheeler. So all that was bundled in. During the first half of the year, the financing rates for auto loans and two-wheeler loans were also edging up. So a combination of these things had basically put brakes on demand. On the flip side, on the input side, there's also been and continue to be pressure to make the four-wheelers and two-wheelers safer. The quality of the safety, both active and passive systems, for some of the most widely bought cars has to get upgraded. and that means higher costs into the system for passenger safety. The entire platforms on which the car is built has to be upgraded to make it more crash-worthy. All these are actually major structural change in the auto industry. I think the understanding of the market and of various commentators on these aspects are very poor, and essentially there's going to be an input cost rise because the quality of the product is going up in terms of the safety, the BS6 norms, and the engine, the transmissions, the entire emission systems have to be upgraded. So that is the reason why you see some margin pressure coming through in two-wheelers and four-wheelers. And also, as I said, in the first half of 18, you had demand pressures which continue to plague the system.
Okay, so give us your summary of the investment climate as you see it, given the score of events that are lined up globally as well as locally. Are you more optimistic? Because so far into the year, India's lagged the rest of the emerging market world. But that's also because we were relatively more resilient in 2018, at least on an index level, not in terms of broader markets and individual stocks. How do you map the investment climate for the year?
I think 2018, the first half will be very choppy. I think the political noise will go up, economic populism will go up, the pressures on the NBFC system will continue to come and hit the market in episodes. There will be 1 week where everything will be quiet, and another week when suddenly something will be revealed, and it will create again some kind of panic in the market. So I really think that Jan to June is going to be very choppy, mostly sideways, maybe slightly down. Until we see a political stability or at least the elections get done. I think we need to revisit where we stand in terms of global and Indian growth in around May, June. My view is that India's growth still remains at the 7% level. My view is that commodity prices still remain soft to down through 2019. My view is that trade tensions and geopolitical tensions will continue to be ever present, and something this has never been the case in the last 10 years, but since 2017-18, especially since the second half of 2018, geopolitical tensions have risen and they will continue to rise. I think therefore India to that extent is in a much better place than some of the large emerging markets. So India has the potential to outperform the pack. It all depends upon where we are in 2018 June in terms of the political administration in place. It also depends mostly on what kind of recovery we see in the broader construction and capital goods space by then.
Right, Sandeep, appreciate your time and glad you could join us. Markets are not looking bad, whereas bulk of the action is still concentrated around ICICI Bank.